Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, Trump's ACA subsidy bombshell threatens to derail US shutdown deal, spooking healthcare stocks and blinding the Fed. Today, we'll take a closer look at this last-minute political maneuver and its implications for Federal Reserve policy and the entire healthcare sector. Second, Trump's radical proposal to give ACA funds directly to citizens sends health insurer stocks tumbling and US political risk soaring. We'll explore how this voucherization experiment could reshape consumer spending and what rising sovereign risk signals for US Treasury borrowing costs. Third, US cybersecurity in retreat due to budget cuts, creating $1 trillion liability and unfunded mandate for corporate America. We'll analyse why this growing cybersecurity deficit matters now and how this unfunded mandate could drag on corporate profits and economic growth. After a record-breaking 39 days, the longest government shutdown in US history might finally be cracking. Senate Majority Leader John Thune just confirmed a promising turn in bipartisan talks, signalling a potential end to the gridlock that has sidelined federal workers and disrupted critical services. From a macroeconomic perspective, a shutdown this long acts as a direct brake on the economy. You know, economists measure a country's economic health using something called gross domestic product, or GDP, which is the total value of all goods and services produced. When the government shuts down, federal spending and the work of federal employees simply vanish from that calculation. The Congressional Budget Office has estimated that a shutdown like this can shave 0.2 to 0.3 percentage points off quarterly GDP growth for every month it lasts. While some of that activity might bounce back after the government reopens, a significant portion of the economic loss is permanent. You can't get back the lost productivity or the cancelled trips to national parks, but this is not a simple story of a breakthrough. We're seeing Thune project optimism, while at the same time, Senate Democratic leader Chuck Schumer is going on the attack, accusing the administration of playing politics by withholding SNAP food stamp funding and reducing airline flights. The real-world cost of this stalemate is escalating. An estimated 10,000 young children and families have already lost access to Head Start, early learning and nutrition programs. Interestingly enough, the disruption goes far beyond the services you see. We previously analysed how a shutdown forces the Fed to fly almost completely blind, leaning on noisier proxies like weekly jobless claims. That heightens the risk of a policy mistake and amplifies the internal split we talked about a while back, with some voices pushing for more aggressive easing. The government agencies that publish critical economic reports, like the monthly jobs report and the inflation data known as the CPI, are closed. The thing is, the Federal Reserve relies on this data to make decisions about interest rates. Without it, the Fed is essentially flying blind, increasing the risk of making a policy mistake that could affect everyone's borrowing costs. This uncertainty also spooks consumers. Recent data from the University of Michigan's Consumer Sentiment Index showed a sharp plunge to a near 3-year low driven by this political dysfunction. This is a leading indicator, and it suggests people may pull back on spending, which is a major headwind for the economy. And just as lawmakers were negotiating deals to reopen the government, the entire board was just flipped over. This is where the situation takes a more complex turn. Former President Donald Trump dropped a bombshell on his Truth Social platform, urging Senate Republicans to completely redirect healthcare funding. His statement calls for the hundreds of billions of dollars currently subsidizing insurance companies under the Affordable Care Act to be sent directly to the people. This injects a massive new variable into the equation at the last second. The Affordable Care Act, or ACA, uses these subsidies, specifically premium tax credits, to make health insurance affordable for millions. If these subsidies, which were extended through 2025, were to be eliminated or redirected, the consequences would be immediate. A while back, we walked through what that looks like on the ground. For a 45-year-old earning about $20,000, premiums can jump from roughly $0 to over $400 a month, an expense spike that tends to spill into higher delinquencies on credit cards and auto loans, especially in high enrollment states. This move introduces a massive new conflict into the final hours of negotiation, directly impacting the 24 million people who rely on ACA marketplace subsidies. To understand the stakes, consider this. Research from organisations like the Urban Institute projects that ending these subsidies would cause about 4 million people to lose their health insurance. For healthcare providers like hospitals, it could mean a revenue loss of over $32 billion as they face a surge in patients who can't pay their bills. So for investors, this creates a clear set of winners and losers. Health insurance and hospital stocks will be under immense pressure, while funds might be redirected elsewhere, perhaps to sectors like defence or agriculture, if they are prioritised in a new deal. Continuing our earlier discussion, remember the political twist. More than half of marketplace enrollees live in Republican congressional districts, and a large share of premium tax credits flow to states won by Trump, so the immediate financial pain doesn't break neatly along partisan lines. We also flagged the risk of adverse selection if healthier people drop coverage, a quirk in CPI that could show a misleading one-off deflationary dip before premiums rise again, and the longer-run threat of job lock that can choke off entrepreneurship. And even if Congress reaches a compromise, the Bipartisan Policy Center warned that once consumers see unaffordable premiums, many won't come back to check later, making some of the damage stick. While senators in Washington are trying to solve one crisis, a new high-stakes battle over the fundamental structure of American healthcare has just been declared. The path to reopening the government has suddenly become far more complicated. Looking ahead, the key things to watch are, first, the final details of any spending bill. Does it touch the ACA subsidies? The answer will dictate performance in the healthcare sector. Second, once the government reopens, watch for the flood of delayed economic data. The first jobs report and inflation numbers will give us the first real measure of the shutdown's economic damage. As we noted a while back, keep an eye on the health insurance component of CPI for any quirky one-off effects, and track final ACA enrollment numbers for signs of adverse selection. Until the data spigot is fully back on, the Fed will be reading more volatile proxies like weekly jobless claims, and that's where any hint of the central bank's internal debate may show up in market pricing. These figures will be crucial for the Federal Reserve's next interest rate decision, which in turn affects stock markets, bond yields, and the US dollar's strength on the global stage. We were just talking about that last-minute bombshell from Donald Trump, and now we need to dig deeper into his radical new plan, divert hundreds of billions of dollars away from insurance companies and send the cash directly to the American people. This proposal lands at a time of serious economic damage from the shutdown. After all, when people are uncertain about the government and their own finances, they stop spending. We're seeing this in real time. The University of Michigan's Consumer Sentiment Index, a key measure of economic confidence, just fell to its second lowest point since 1978. And that's a huge deal, since consumer spending makes up about 70% of the US economy. The Congressional Budget Office estimates this shutdown could slash fourth quarter GDP growth by up to 2 percentage points. A while back, we said a clean way to confirm that consumption shock would be a drop in grocery sales in the Advanced Monthly Retail Trade Survey. So watch that as a near-term reality check. This bombshell proposal comes just one day after Senate Republicans flatly rejected a Democratic deal aimed at reopening the government. The core of that failed deal was protecting federal healthcare subsidies under the Affordable Care Act subsidies that more than 20 million Americans rely on and are set to expire at the end of December. We previously analysed how, during this shutdown, forcing states to backstop federal programs creates a hidden fiscal drag and can even invite scrutiny from credit rating agencies. The latest development is that if ACA subsidies lapse or are reshaped into direct cash states, could be pressured to plug gaps or manage enrolment shocks, raising the risk of budget stress that ratings firms might flag. But that's not the whole picture. The real turning point is understanding the sheer scale of the economic shock if these subsidies expire. According to the Commonwealth Fund, state economies would lose $34 billion in GDP and 286,000 jobs would be lost nationwide. The CBO also projects that 2.2 million Americans would become uninsured in the first year alone. This is the fiscal cliff everyone is worried about. This is exactly how a federal political problem can spill over and create long-term divergence across regions, a theme we highlighted when the fight over food aid became one of the bitter flashpoints of this shutdown. Now, Trump is attempting to sidestep the entire debate. In a post on Truth Social, he urged Republicans to take the funds currently going to what he called money-sucking insurance companies and have them be sent directly to the people so that they can purchase their own, much better, healthcare. This idea of switching from subsidized services to direct cash payments is actually a major economic experiment. Economists call this the voucherization of social benefits. The key difference is that subsidies for insurance are an in-kind benefit, meaning the money can only be used for healthcare. Direct cash is fungible, people can spend it on anything. This could completely change consumer spending patterns and create unpredictable pressure on core inflation measures like the CPI. And the market is already reacting. Now, get this. The proposal creates massive policy uncertainty for the entire health insurance industry. It directly threatens the business model of the ACA marketplace. We are already seeing high volatility in the stocks of health insurers with heavy exposure to these plans like Centene and Molina. As we noted a while back, markets are starting to price a US political risk premium. This kind of policy whiplash only reinforces that repricing across the sector. However, if you zoom out, you'll see another layer of strategy at play. The conflict is escalating into a full-blown political war. Trump is now publicly pressuring his own party to use the nuclear option and terminate the filibuster, the Senate rule that requires 60 votes to pass most legislation. This level of political dysfunction has a real price that global markets can measure. You can see it in the US sovereign credit default swap, or CDS. Think of it as an insurance policy on a country's debt. As this political crisis deepens, the cost to insure against a US default is rising. This signals that global investors perceive a higher risk, which could eventually translate into higher borrowing costs for the US. Treasury, corporations, and even consumers, as we've discussed before, you'll also see that political risk premiums show up in a sustained move higher in the 10-year Treasury yield. He claims Democrats are cracking like dogs on the shutdown because he is making progress with Republicans on his demand to blow up the filibuster. This transforms a government funding standoff into a high-stakes battle over the fundamental rules of power in Washington. Ultimately, when the US is consumed by this kind of internal conflict, its ability to lead on the world stage is weakened. With nearly half the civilian workforce at the Pentagon furloughed and thousands of State Department staff on leave, US diplomatic and aid functions are crippled. This creates a policy vacuum that other global powers, including China, can potentially use to expand their influence. So the situation presents a fascinating duality. On one side, we have the immediate political theatre, while on the other, it exposes some clear market signals. Keep an eye on the US. Sovereign CDS spread as a real-time indicator of perceived political risk. Also, monitor the stock performance of health insurers, which will signal how the market views the future of the ACA. As we flagged earlier, watch for warnings from state budget offices and credit rating agencies if backstopping pressures build, and track the 10-year Treasury yield for signs that the political risk premium is rising. And on the demand side, check the Advanced Monthly Retail Trade Survey, especially grocery sales, for confirmation that the consumption hit is feeding through. And of course, we'll be watching for any signs of a breakthrough to end this historic shutdown. Speaking of national risk stemming from government dysfunction, a different kind of threat is quietly escalating. A former National Security Council advisor just issued a stark warning about US cybersecurity, saying, "We're handing off coordination to industry while kicking away the ladder." That single quote captures a massive and worrying shift in America's defense strategy. A recent assessment by the US Cyberspace Solarium Commission found the nation is officially slipping in its progress on 82 critical cyber defense goals. One of the commission's leaders, a retired admiral, said they were surprised and disappointed by the backslide. The primary cause? Deep budget cuts at the Cybersecurity and Infrastructure Agency, or CISA, and a gutting of personnel across the State Department and the National Science Foundation. This has left top leadership positions at Cyber Command and the National Security Agency vacant for 8 months, which one US representative said is translating to inertia and lack of direction. What really brought this to a head was the next development, a growing cybersecurity deficit. Essentially, these budget cuts are creating a hidden off-balance sheet liability for the entire US economy. Think of it this way. Every dollar saved in the budget today adds to a mountain of unaddressed risk. Research from Lloyd's and the University of Cambridge estimated that a single major cyber attack on the US electrical grid could trigger economic losses of up to $1 trillion. That single event could dwarf any initial budget savings and potentially trigger a recessionary shock. And the threat itself is evolving at a terrifying pace. Cyber criminals are using artificial intelligence to launch sophisticated extortion schemes. In one case, a generative AI chatbot was used to attack 17 different organizations with threats demanding up to $500,000. Here's where it gets interesting. A dangerous asymmetry is emerging. Unlike past arms races where offense and defense scaled together, AI allows attackers' capabilities to grow exponentially while our coordinated defense is being defunded. Research firm Darktrace reported a 135% increase in novel social engineering attacks using generative AI in just a 1-month period. This allows adversaries to scale their attacks at a speed and sophistication we've never seen before, while our ability to defend is actually degrading. Meanwhile, a Chinese state-sponsored group known as Volt Typhoon has already infiltrated US critical infrastructure, an Attack One expert called an operational preparation of the battlefield. The situation is made worse by the fact that a key law, one that enabled companies to share threat information without antitrust concerns, has been allowed to lapse. Believe it or not, this isn't just about one law expiring. This dismantling of public-private partnerships creates information silos. These are gaps in communication and coordination that sophisticated state-sponsored attackers like Volt Typhoon are specifically designed to exploit. By breaking these collaborative channels, we are essentially handing a strategic advantage to our rivals, allowing them to quietly prepare the battlefield inside our most critical systems, undetected. An executive order was also amended to remove enforcement mechanisms for secure software development. This decision brings both short-term budget savings and comes with the inherent risk of creating what experts call a software liability vacuum. This policy shift actually reverses the trend seen in almost every other major industry, like auto safety, where producers are held accountable. By removing enforcement, the incentive for major tech vendors to invest in security is reduced. This effectively shifts the systemic risk from a few large software producers to thousands of downstream businesses and consumers who will ultimately bear the financial and operational brunt of vulnerabilities in the foundational products they rely on every day. Cybersecurity experts are now calling the situation a death by 1,000 paper cuts. As the government slashes budgets and vital partnerships are defunded, the responsibility is falling on a private sector that is losing the very tools it needs to fight back. This is creating what economists call an unfunded mandate for private companies. This acts as a direct drag on corporate profitability as firms are forced to divert capital away from growth and innovation just to play defense. To put this in perspective, Gartner projects that worldwide spending on information security will hit $213 billion in 2025. This represents a massive redirection of capital from productive investment to reactive defense, a burden being pushed onto companies because the coordinated government shield is being lowered. As Admiral Mark Montgomery stated, you can't continue to cut. So where do we go from here? The focal points to watch now are twofold. First, pay attention to any legislative efforts to restore public-private information sharing frameworks. Second, watch the earnings reports of companies in critical sectors. If their capital expenditures slow down while their security spending skyrockets, that's a clear signpost that this unfunded mandate is beginning to drag on broader economic growth, affecting everything from stock prices of non-security companies to their ability to hire.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.